my side. Thank you so much for joining. I appreciate that. So what we're going to do, I just want us to focus on the two ratios that we need to finalize under liquidity. Then I think we'll be done with liquidity. I'll be ready for us to go and look at one question paper, and we know that we finalize this thing of ratios now, and then we move on. So right now I'm sharing my screen. It is just that example one that we have been working on. So what was required here, there's a lot of ratios that they wanted us to calculate here. They were saying calculate and interpret the following financial indicators. But for me, I didn't want to focus on these profitability ratios more. The ratios that I wanted to focus on, it was the current ratio, acid test ratio, those of liquidity, rate of stock turnover. This is a stock turnover rate. Then we have stock holding period. These are the ratios that we looked at. Now I want us to focus on these ones. Debtors average collection period, creditors average payment period. These are the two that I want us to look at for today. We do the calculation and then we see if we can comment on the ratios, and then after that I think I'll be okay for me to move on to the question paper. These are the ratios. We don't need to calculate them, but we'll definitely be looking at them when we start doing the question paper. Okay guys, I hope you can see the screen on your side. Here I have a spreadsheet of debtors collection period here. We're going to do the calculation and then we comment on it. Creditors payment period, we're going to do a calculation and then we comment on it. Before you even do these calculations, very important that you understand the meaning of the two ratios. Each and every ratio or a financial indicator that you're going to comment on, that you're going to interpret, you cannot interpret something that you don't understand. There's no way that you can interpret something you don't understand. You have to understand the concept before you can be able to explain it to someone else. So if you don't understand it, you cannot explain it to someone else. Okay, so I have an average debtors collection period here, which is number 5, and then I have an average creditors payment period, which is number 6, and then here I have ways to improve liquidity, because liquidity as a whole, it's very important that it has to be in order all the time. If it's not good, you have to improve it. You have to understand the ways of improving what? The liquidity. So I'm just going to quickly go straight to average debtors collection period and understand what is that. So now here what they're saying is that credit provided to debtors means that the undertaking funds are being utilized by outside parties. It is necessary to determine the average collection period so that the firm can budget accordingly. What we're saying here is that the money that is sitting with our debtors, the money that is sitting with debtors, this is the cash that we should be using for our operations in our business. So if the money is sitting with debtors, which means now we are restricted from using that cash and to grow our business. There's no way that I can continue operating without the cash. I need cash that is sitting with debtors so that I can be able to purchase the trading stock and be able to sell again. So if the money is sitting with debtors, there's no way that I can carry on with my operations. So what do I need to do now? I need to collect that cash. So that cash has to be collected. I need to find ways of collecting that cash as soon as possible to get my money from debtors. Then I'm able to continue with my operations. I'm able to buy trading stock. I'm able to sell that trading stock. Otherwise, without collecting it, it's a problem. So average debtors collection period, we're trying to calculate how many days does it take us to collect the money that is sitting with debtors. Okay, usually we have to collect cash from debtors within 30 days. That one is a must. And then if we're failing to do that, then we must show an improvement in the following year, whether we're improving or not. But collecting cash within 30 days from debtors, that is crucial, very important. Average debtors multiplied by 365 over credit sales. Average trade debtors over credit sales multiplied by 365 over 1. This is the formula that we're going to be using to do the calculation, right? Debtors collection period, what is the formula saying? Is equal to average. Is equal to average trade debtors. Okay. Over what? We have average trade debtors, and then we're going to say over credit sales. That's what they're saying here. Credit sales, and then multiply by 365. Multiply by 365 over 1. Okay. So we're going to have 365 over 1 this side. That is there. I need to multiply by the 365 over 1. That is the formula that we are using to calculate our debtors collection period. Okay, that is the formula that we are using to calculate our debtors collection period. Okay, now I'm going to do the calculation for 2013. I'm going to do the calculation for 2012. But let's carry on understanding the ratio or the financial indicator. NP, which means this is very important, something that we need to be careful of. If credit sales are not given from the formula, you can see there that we have credit sales there. If credit sales are not provided, then use total sales, which is a turnover. And if trade debtors are not given, then use the trade and other receivables or debtors at the end. You see, if trade or other debtors are not given, you need to use trade and other receivables or debtors at the end. You can see there they want average trade debtors. But now, for you to calculate average, you need to take the opening balance and the closing balance of your debtors. If they are not provided, then you're going to use the ones at the end. That's the only thing we're going to do. So that's why we need to check here, guys, when we're doing the calculation. Then they say in comments, if collection period is longer than expected, the collection period should be about 30 days, right? It has to be about 30 days. But what is more important is that it has to be less than the creditor's payment period. Debtor's collection period has always have to be less than the creditor's payment period. You cannot pay your creditors first before you collect your money. You need to start collecting your cash from debtors, then you can pay your creditors. Okay. Comments if collection period is longer than expected. You see now, this is what I'm going to use to comment on the ratio. Cash is tied up unnecessarily. You see, that's a problem. This is something I need to check. If debtors collection period is too long, maybe 60 days, 90 days, 100 days, 365 days, there is money there that is sitting with those debtors. So the money is tied up unnecessarily. Let us collect our cash from debtors and we use that money to grow our business. Greater risk of bad debts. You see, there is definitely a risk. There is definitely a risk of what? Of bad debt. So some of those debtors may be written off because they're taking long to pay. Then they may not even afford to pay us. Indifference amongst debtors, increase in administrative cost in monitoring debtors. You see now, these are the things that I can use to comment on my debtors collection period, but I will just check the numbers first. Are the numbers too much, too big, or they are lower? Debtors collection period has always have to be lower at all times. 30 days, less than 30 days, maybe it's about, if it's above 30 days, it can be 32, 35, 36 days, but it doesn't have to go to 60. No, that's not what we want. It has to remain 30 or less or around 30 days. Take note that the debtors collection period will depend on the type of commodity and undertaking's credit policy. You see those things now. It depends sometimes on the type of goods that you're providing, because some other things, you may sell them today and then it take 6 months to pay and all those things. So, but obviously that is something that you're going to analyze based on your business, based on the business that you're running, based on the product that you're offering. So but the number of days have to be reasonable, debtors collection period. Most customers tend to withhold payment for as long as credit terms allow, while others advantage themselves with discount for prompt payments, hence seeing screening of debtors before credit is extended is paramount. If you give your debtors 60 days to pay, they will stay up and finish those 60 days credit terms. Then they will pay you in 2 months. If you give them 5 months to pay, they will take that 5 months and pay you after 5 months. Make sure that you only allow them 30 days to pay so that they can pay you within 30 days. Then if there is those few debtors that pay after 30 days, it's still okay, but you're minimizing the risk of writing off some other debtors. Okay. So that is our debtors collection period. I want us to do the calculation for the debtors collection period before we go to the creditors payment period. So I'll just go straight to the question. This is example 1, and we have the formula here. Average. Our formula is saying average debtors over credit sales. Average debtors over credit sales. So we need to check what is going to happen here. Average creditors over debtor sales. Okay. Now let's go and check on the question. Let's go and check on the question. So here they're saying here, Mandla Trading Company Ltd are general retailers. They aim at a markup of 50% on cost. Sales on credit account for 60% of total sales. So they told us here that sales on credit account for 60% of total sales. The following information was extracted from the accounting records on 28 February 2013 at the end of the financial year. So they're telling us about what? About the credit sales, that it is 60% of total sales. Now, how much sales do I have? Sales, I have 2,349,000 in 2013 and then 1,125,000 in 2012. That's what I need from the formula. I have credit sales here, so which means I need to calculate my credit sales. For 2013, I need to calculate my credit sales for 2012. Okay. Now let's see if we can be able to do that. Let's see if we can be able to do that. And then another thing, we need average trade debtors. Let's go and see if we can get. This is an extract from the balance sheet of tangible assets, current assets, there, inventories, trade and other receivables. There is it there. Trade and other receivables, that is our debtors, and then they're referring us to note number 2. Let's go to and see note number 2 and what is going to happen there. Trade and other receivables, we can see there were trade debtors, with provision for bad debts, accrued income, prepaid expenses, SARS income tax. We don't need all these other things. We need trade debtors, average trade debtors. That's all we need. So how much is our trade debtors here? We have 65,000 for the current financial year. We have 54,000 for the previous financial year. So that is, if we're doing the calculation for 2013, we need to take these two, add them together, divided by 2. So for us to be able to get the average. So I'm going to say 65,000 rands plus 54,000 rands. So that will be my calculation. How much? 65 plus 54. Okay, 65,000 rands plus 54,000 rands. Okay, and then I'm going to divide it by 2 because we're dealing with average, guys. If it's an average all the time, make sure that you divide it by 2 or you multiply it by 1/2. Then over credit sales, how much will be our credit sales here? They gave us a credit sales of the total sales of 2,349,000. Then they said 60% of total sales, they account for credit sales. Sales on credit account for 60% of total sales. So these 2,349,000 rands, 2,349,000 rands, 2,349,000 rands. I need to multiply it by 60% for me to be able to get what? To get my credit sales. Then I multiply it by 365 over 1. Are you guys still following this one? I hope it's still together, guys. I hope you guys are still following. Now, I want to see then how much K will be our trade data as the average there. If we punch the calculator, how much will be the average there? You say 65 plus 54 divided by 2, how much we're getting?
Thousand.
Yes, please come again.
1,000.
31,000, eh?
Yeah.
Okay, thank you on that. Over, how much we're getting for that one? 2,349,000 and 60%.
1,409,400.
1,000,000.
1,9,400.
9,400 like this now.
Yeah.
Okay, thank you on that. Now let's get the total answer now. Now let's get the total answer and see how much we're getting.
$15.7.
15,7.
15.8.
15,8. I'm not getting that one. I'm not getting that one. That's 1,000. Is this still 1,000? Eh? I'm getting 8.02.
I got 61 for the top one.
61 here.
Yeah. Let me redo it.
So here is 59,500 rands.
Mm,
Are you getting the same 59,500 rands? How much are you getting, Smang, on your side?
yeah, it is 59,500.
Okay. Then now this one is correct. 1,409,400. Now let's get the total, you guys. How much are we going to get? How much are we getting?
$15.4.
15.41. Yes, exactly. 15.441 days. Okay. So this is our average debtors collection period. Okay. This is our average debtors collection period. Now, let's check the other one now. Okay. Now we're going to work on the one of 2012 now. 2012 now. So for 2012, we cannot calculate the average. So if we want to calculate the average trade debtors, we cannot calculate it for 2012. The only thing that we need to do here, we need to take the trade debtors because we don't have trade debtors for 2011. If you're calculating the average, we're going to take 54,000 plus trade debtors of 2011, of which they did not provide us with that. We're not provided with that information. So if that information is not provided, the note told us there that we need to use what? We need to use debtors at the end. There's something like that. They told us there to say, and if trade debtors are not given, then use trade and other receivables or trade or debtors at end. So we are just going to focus on these trade debtors at the end here, these ones. So we're going to use 54,000 rand, 54,000 as what? As my numerator. I'm going to use my 54,000 as my numerator. And then now for my for my denominator, I need to take my sales multiplied by 60%, 1,125,000 rands, as we can see there. 1,125,000 rands multiplied by 60%, okay? Multiplied by 60%, and then times 365 over 1, okay? Then now, I'm still going to have 54,000. I'm still going to have my 54,000 there on top. I'm still going to have my 54,000 here. Okay. But how much? 1,125,000 times 60%, how much are we getting? One million 125,000 times 60%, how much are we getting?
675,000.
675,000 rands. I hope you guys are still following. Thank you, Let. Now, let's get the total and see how much we're going to get.
$20.2.
65. Sorry, please come again. How much you getting?
29.2.
29.2. Okay, thank you. 29.2 days. Okay. 29.2 days. This is our average debtors collection period. 2013 and 2012. Okay, what is happening is there is an improvement here or there's a decline.
Improvement.
Why are we saying it's an improvement?
Because we're collecting the money quicker than we were before.
Exactly, we're now collecting the money in 15 days instead of 29 in the previous year. In the previous year, it was taking us 29 days to collect cash. Now it's taking us 15 days to collect cash from our debtors. This is a very good thing. It's something that we should be happy for. As someone who's working in the finance department, as someone who is working with debtors, we should be happy if we see something like this. Are you following, Smang, on your side?
Yeah, I'm following.
Okay, perfect. Now we're gonna look at the comments. We're gonna interpret the ratio, but before we do that, let's go and calculate creditors payment period. Okay. Creditors payment period. Now we're looking at this period that take us, how long does it take us to pay our creditors, right? So now they're saying here, an undertaking can finance its activities through its own funds, right? That means owners, equity, or partners, or equity or shareholders equity. So by saying that we can finance activities through its own fund, they talk about a company here. The company can finance its activities through its own funds by issuing shares and get money from shareholders. Number two, with outside funds. That's why we're talking about borrowings now, long-term loans and creditors. By going and buy on credit, buying trading stock on credit, it's like you're borrowing money. That is a funding because you got a stock without paying anything. That is a funding that you're getting to run your business. Then you're gonna sell this trading stock, you retain your profits, then you pay the rest to your suppliers. That's another method of funding the business. You see, right now, I have nothing in my bank account. If I want to start a business, I have nothing in my bank account. Then I say, okay, fine, I want to start a business, but I have no money. Let me just go to a retailer and buy on credits there. If they allow me to buy on credits, I'm gonna buy there and sell that stock, take my profits and give back their money. Then I'm left with money now, which means I got the funding from outside. That is a long-term loans or creditors. So it can be a long-term loan, it can be what? Creditors, which means buying on credit. Look here, ideally, all firms should establish a credit line and use this source of financing to the maximum because creditors provide ready financing without interest as long as payment terms are maintained. It's very good. This one is better than going to borrow money. Taking a loan, buying on credit is better than taking a loan because they're not going to charge you interest. Your suppliers are just going to give you a trading stock and then you have to pay it back. There will be no interest that they will charge you as long as you are maintaining what's the credit terms or the payment terms. But going to the bank and borrow money, you will pay it back with an interest, which is not a good thing. So having creditors in a company, it's better than having long-term loan. Okay. In any undertaking, the creditor's payment period must always be longer than the debtor's collection period. You see now, you're getting another reason to put a comment. You can compare your debtor's collection period with the creditor's payment period. CPP must always be longer, which means now debtor's collection period must be shorter than the creditor's payment period, as not to place undue pressure on the firm's cash resources. Because now, if you pay your creditors first before you collect, where are you going to get money? How are you going to get money to pay your creditors if you have not yet collected from your debtors? All the people who are owing you must pay you money first before you pay those you are owing. That's a principle. That's a principle. It doesn't only apply to the business. Even you yourself, you cannot pay people you are owing if you have not yet collected your money from those who are owing you. That's a principle. So you must always try that. Now the formula: average trade creditors over credit purchases multiplied by 365, okay, over 1. Then they're saying here, if credit purchases are not given, then use cost of sales. And if trade creditors are not given, then use trade and other payables or creditors at the end. That's all that we have to do here. That's all we have to do here. Now, we can go and start. Now we can go and start maybe calculating, right? We go and start doing the calculation. So the formula here is saying average trade creditors over credit purchases, right? So here I'm going to have what? My credit purchases, okay? Credit purchases, and then here average trade creditors, okay? Average trade creditors times 365 over 1. Now, this is we're going to do a calculation from this formula now, okay? Let's see if we can do it. So I'm going to have my 265 over 1 here. Can we just take all of this and I put it here? Now, average trade creditor, let's go and check if we can be able to get it from our question. Average trade creditors. Here, where is our creditors? Trade and other payables, note number 3. They're saying we must go to note number 3 to see if we have our trade creditors. Note number 3, there is trade creditors there. For the current financial year, 89,000, and then the previous year is 74,000 rands. So I'm going to say 89,000 plus 74,000 rands. 89 plus 74. 89,000 plus 74,000 rands, okay? Then I divide this by 2 because I want an average. Then over credit purchases, did they provide us with the credit purchases here? Let's go and check. Do we have credit purchases? We have cost of sales, operating expenses, operating profit. There's no credit purchases here, but we do have what? We do have cost of sales. Cost of sales, 1,800,000 rands. They said we can use cost of sales. If credit purchases are not given, then use cost of sales. You see? So I'm just going to use the cost of sales of 1,800,000 rand as my denominator. Okay, multiply by 365 over 1. So how much, guys, I'm going to get here? How much am I going to get as my... let's start with the numerator first. Start with the numerator first. $89,000 plus 74,000 divided by 2. How much we're getting?
81,500.
81,500 rands. Thank you on that. 81,500 rands. Okay. Then now our numerator, we know very well that, sorry, our denominator is 1,800,000 rands. Then now multiply by 365 over 1. Okay. Then now how much will be our total now? How much are we going to get as a total? How much are we getting?
16.53.
16.53 days, exactly. 16.53 days. Thank you on that. 16.53 days. This is our creditors payment period for the current year, which is 2013. Now we're going straight to 2012. Let's go and see. For us to be able to calculate that of 2012, average creditors, obviously we don't have the average this year. We're just going to use 74,000 rands. So I'm just going to say 74,000 rands here because we only have the current, and then we only have 74,000. We don't have 2011, the creditors. Then we go and use the cost of sales, which is 750,000 rands. There is cost of sales there. I'm going to go and say over 750,000 rands, right? Then multiply by 365 over 1. For this one, you don't even have to do another step. We just need to go straight to the answer here. We just need to go straight to the answer. So how much are we going to get as our total here?
$36,01.
36,01. Thank you on that. 36,01 days. Okay, 36,0101 days. So this is our creditors payment period. Now, is this an improvement or a decline?
Fine.
The decline. Why are we saying it's a decline?
Because if we pay our creditors too early, then you might run into like cash flow problems.
Exactly, very good on that. You may have some cash flow problems. Sometimes it can be good. It depends on how you like maybe explain it, right? It depends on how you explain it. Someone else may say it's good because by paying early, it means you're also avoiding being charged interest here. By paying early also, it can help you to get your settlement discounts. You know, when you're paying your creditors early, they can give you some discounts because you're paying early. It can be good, right? But someone else may say it's bad as it is going to affect cash flow, which is true, which is correct. That's a valid reason. It's a very good reason. But also someone else may say it's good. So it depends on how you explain it. For creditors payment period, it doesn't really have to go down. It has to maybe increase and be around 60 days. But also trying to pay your creditors early can be a good thing for the business, because it will be easy for you to negotiate. Even next time they will allow you to buy on credit, because they know you're paying early. You see, someone can say it's good, someone can say it's bad, but also we also need to judge that based on our debtors collection period, comparing now to say, okay, if I'm paying within 60 days, I was paying 36 last year, now I'm paying 60 within 16 days, but it is after I have collected already. You see, it is after I have collected, because if I collect within 15 days, then I pay within 16 days. It's good. I don't see anything wrong with that. Same thing as previous year. I was collecting within 29 days, then I pay after I have collected in both years, which is good. But also I tried to reduce my days, number of days for me that takes me to pay my creditors. So for this one, Kinere, we can say it's good. There are more reasons to say it's good than saying it's a decline, right? But the example that the reason that you gave me to say it may strain our cash flow, right? It can create cash flow problems. It's a good one, because right, paying your creditors too early, it can obviously create some cash flow problems, because the cash that you're supposed to be keeping and doing other things, you're paying it to your creditors. You see. But also it can be good in this scenario. So you can see now how you can put your comments here strategically. You have to compare the two. Firstly, you can see there was an improvement in debtors collection period. There's no doubt with that. That's the first thing that we need to state, right? Debtors collection period has improved from 29 days in the previous year to 15 days in the current year. That is my first comment that I'm going to state. Even here, they did tell us about some things that we may look up. Money is tied up unnecessary. So this one, money is not tied up in debtors, because we're collecting it too early, which is very good. Okay. Now let's do the interpretation again, because that's what is more important. That's what we want to do. Looking at the interpretation, obviously we need to consider both. We need to consider both debtors collection period and the creditors payment period. Okay. Let me do this. Just want to do something here. It's not working. It's not working for me. Okay, let me do this. Just want to do something here. Okay, so I've tried to hide the other part. Now, we're going to interpret these two. Now we're going to start talking about debtors collection period. Here, debtors collection period has improved from 29 days in 2012 to 15 days in 2013. That is a starting point. Tell us about the trend, right? Tell us about the trend. Debtors collection period. Debtors collection period improved, right? We're saying it has improved from 29 days, 29.2 days in 2012, right? To 15.41 days in 2013. Okay. I just stated a trend. That is my comment, the first one. Just tell us what happened. The numbers have dropped, which is a good thing, right? Debtors collection period improved from 29.2 days in 2012 to 15.41 days in 2013. You cannot just say it has improved and then you end there. That's not a proper comment from a grade 12 student. You must quote figures. That's why they always say comment and quote figures. I need to see it has improved from where to where. You need to tell me it has improved from 29.2 days in 2012 to 15.41 days in 2013. You quoted figures. You told me it has improved, but also you quoted figures. That's a very good comment, the best comment that I want to see. Okay, now looking at the trend of credits as payment period, you can say it improved, you can say it declined. It depends on how you want to support it, right? It will depend on how you want to support it. But on this one, I want us to say credits as payment period improved also, right? Because yes, it went down to 16 days, but it still doesn't affect us because it is still after collecting, right? It is still after collecting. So credits as payment period improved from 36.01 days in 2012 to 16.53, right? 16.53 days in 2013. Okay. Now, I've stated the trend. There's a lot of things you can write here. I've stated the trend of debtors collection period and the trend of creditors payment period. Now I'm going to compare my creditors payment period of 2012 to my debtors collection period of 2012 and compare to that of 2013 to see if I am in a good position in both years. Right? So in 2012, creditors are paid after collecting cash, after cash has been collected from debtors. By how many days? If I'm saying 36 minus 29, the difference between the two, 36.01 minus 29.2. How much? 9.8 days, right? Creditors are paid 9.8 days after collecting from debtors. That's a good thing because we're collecting within 29 days and then we're paying within 30 days, which means now we do have cash available to pay our creditors. Then it's fine. Let's pay them. So that's a comment that you can put here to say in 2012, creditors are paid 9.81 days, 9.81 days after collections from debtors, right? Which is a good thing because I always want to collect first from debtors and then I pay my creditors, right? Then now, again, in 2013, how many days? I think it's just a 1 day here or even less than a day. 16.53 minus 15.41, 1.12. Well, we are very quick here in paying. We're very quick, which it can create a problem. It can create a problem. So what you were saying, Kinelwe, it's a valid point. That's why I'm saying it is a valid point. It just depends on how you support it. Sometimes collecting today, tomorrow I'm paying my creditors. I didn't even analyze whether is it a good time to pay on all of that. You see, but also at the same time, if I've already collected my money from debtors, why am I not paying my creditors? You see, what's stopping me? Because cash is available. I do have cash. I've already collected it. So in 2013, what's happening? creditors are paid. So it's actually going to be the same comment that I'm going to put here. And then the only thing that will be different is this one. 1.2, 1.12 days after collection from debtors. Okay, that's a comment. Now, in terms of liquidity position, now we can come here. Money is tied up unnecessarily from debtors. This is not true in this situation because we are very quick as compared to the previous year. So, which means now there's no cash that is tied up unnecessarily. There's no cash or there's no money that is tied up unnecessarily, right? This indicates that no cash is tied up unnecessarily, right? Unnecessarily. So there's no cash that is tied up unnecessarily. So that is what I'm going to comment here. What they said here. There is no cash that is tied up unnecessarily, right? Because I'm very quick to do what? I'm very quick to do my collection. I'm very quick to do my collections. It's a very good comment that we can put in there. What else can we say? What else can we say? Is there anything that we can say here? Even coming back here, greater risk of bad debt. Is there a risk of bad debt here by looking at the numbers?
No.
Definitely no. Yes. There's no risk of bad debt. The risk of bad debt is very low, right? The risk of bad debt is very low, right? As collections are made quicker than the previous year, right? Quicker than the previous year, okay? It's a very good comment that we can put here. Anything else that we can say here? What did they say again here? You can see they're talking about indifference among debtors. I don't see this also. Increase in administrative cost in monitoring debtors. This one, we're going to save, right? We're going to save unnecessary cost. We're going to save unnecessarily administrative costs because we're collecting very quick. So there will be no unnecessary administrative cost, as you can see here. Right? No administrative cost that will be incurred, or less administrative cost, less administrative costs will be incurred, right? As what? As debtors, as collections, as money is collected quicker from debtors, and also payments are made very quick as well, right? So there will be less administrative cost will be incurred. And then we can close it now. Obviously, we always have to talk about the liquidity position, right? We should always talk about the liquidity position because all these ratios are talking about the liquidity position. This company is in a good liquidity position and it should be able to pay short-term debt. Yes, if we're able to collect our cash on time, we have to be able to pay. Even this one, even the stock holding period and stock turnover rate was telling us about a good liquidity position. Current ratio, acid test ratio, it was telling us about the company is in a good liquidity position and it should be able to pay short-term debts. However, improvement is required on the acid test ratio. It was only the acid test ratio that was questionable, but everything else was good. So in overall, the liquidity position of the company is good. I don't see anything that we should be concerned about. The liquidity position, it is in a good position. So we should be able to meet our short-term obligations. Nothing we should be worried about. I don't see anything that should stress us. Anything else, guys? Any questions on your side? Anything that is not clear?
No.
Are we happy with our data collection period? Can you see how you play with your ratios? Like you compare this to this, or you compare, you go horizontal, you go vertical, you go horizontal. So it depends. Like these ones, that's why I'm doing them 2 by 2 here. Data collection period, credit as payment period, because these two they have a relationship. Again, with this one, stock turnover rate, stock holding period, they have a relationship. So your comments should cover them both at once. Even these comments should cover creditors and debtors at once because they have a relationship. Even these two, current ratio, acid test ratio, they have a relationship. So you have to cover them both in your comments. So that is the strategy of dealing with them both at once. You can see because they are related. So which is something important. Any questions on your side, Smava?
No, I'm good.
Okay, I'm glad to hear that. Guys, you see what's going to happen now? On Monday, we're going to look at the